Every trading course teaches you the same thing. Win more trades than you lose, and profitability follows. Track your win rate. Aim for 60%. Aim for 70%. Because if you win more than you lose, the math is on your side. That instruction is mathematically wrong, and it is not a small mistake. Since 2018, European financial regulators have required CFD and Forex brokers to disclose the percentage of retail accounts losing money. The figures range from 65 to 89%. Not a slim majority, not slightly more than half. The overwhelming majority. And many of those traders, if you check their trade logs, won more trades than they lost. Win rate was not the problem. The equation was, you were not a bad trader. You were given half a formula and told it was complete. In this video, we are going to expose 4 hidden mechanics. First, why win rate is a vanity metric and the arithmetic that proves it. Second, why the human brain is neurologically wired to destroy your reward-to-risk ratio, no matter what your trading rules say. Third, why the instinct traders use to fix a bad win rate makes the underlying problem worse. And fourth, the single calculation that tells you whether your trading system actually has an edge. The first thing they never showed you is this. Win rate is only one variable in a 2-variable equation. Most traders know their win rate. Ask a trader how often they win, and they will tell you immediately. 60%. 55%. Running at 70% this month. It is the first number they track. The first thing they report. The benchmark against which they measure whether the system is working. Ask the same trader what their average winning trade makes compared to their average losing trade. Most of them do not know. They have never calculated it. And that missing number is where the profit disappears. Profitability is not determined by win rate alone. It is determined by expected value. The formula is simple. Take your win rate and multiply it by your average winning trade, measured in R, which is 1 unit of your risk. Then take your loss rate and multiply it by your average losing trade. Subtract the second from the first. That number, positive or negative, is what your system actually does to your account over time, not what it feels like it is doing, what it mathematically does. Here's what that looks like with real numbers. You win 60% of your trades. Most trading courses would classify that as a reliable system. But if your average winning trade returns half of what your average losing trade costs, half an R, then your expected value per trade is negative. 60% of trades win, each returning 0.5 R. 40% of trades lose, each costing 1 R. Expected value, 0.3 R minus 0.4 R equals negative 0.1 R per trade. That trader wins 60% of the time, and they consistently, reliably lose money. This is not a theory. It is arithmetic. You cannot trade your way around arithmetic. The answer is not lack of discipline or bad instincts. The answer is that trading education teaches win rate as the primary measure of a system's quality and never shows the other half of the formula. A 60% win rate feels like proof, but win rate without reward to risk ratio is a number with no meaning. It tells you how often you were right, and tells you nothing about whether being right is making you money. But even understanding that formula is not enough, because there is a neurological mechanism operating beneath your conscious awareness that is specifically designed by evolution, not by market makers, to produce exactly the wrong win and loss sizes. Every time, in every trade, every trading course gives you the same instruction. Cut your losses short, let your profits run. It is correct advice. It appears on every trading platform, in every trading book, in every introductory course ever written. The problem is that the human brain is neurologically wired to do the exact opposite, and knowing the advice does not override the wiring. In 1998, finance researcher Terence O'Dean analyzed over 10,000 brokerage accounts across a 6-year period. He wanted to know when investors actually sold. What he found was stark. Investors sold their winning positions at a rate approximately 50% higher than they sold their losing positions, not occasionally, consistently, across thousands of accounts, across years of data. They were cutting winners short and holding losers far longer, the exact opposite of what every piece of trading education instructed. These were not beginners guessing randomly. These were active investors who knew the advice. They simply could not follow it. The reason was documented 2 decades earlier by Daniel Kahneman and Amos Tversky. Their prospect theory research established that losses are felt approximately twice as intensely as equivalent-sized gains, not a mindset flaw, a documented, reproducible feature of human decision-making under risk. Here's what that means inside a trade. When a position moves into profit, the brain registers that unrealized gain as something real that can be taken away. The fear of losing it becomes more powerful than the prospect of gaining more. The fastest way to make that fear stop is to close the trade and lock in the win. When a position moves against you, the same mechanism runs in reverse. Closing a losing trade makes the loss permanent. The brain resists that. So the trade stays open and the loss grows. The mechanical outcome is predictable. Average winning trades close typically at 0.5 R to 0.6 R because the profit was taken early. Average losing trades close at 1.5 R to 2.0 R because they were held through the discomfort of realizing the loss. Win rate climbs, expected value deteriorates, and at no point did the trader intend for any of it. Brad Barber and Terence O'Dean documented this at scale in 2000 in a study of 66,000 households. The most actively trading households earned an average net annual return of 11.4%, while the market returned 17.9% over the same period, a gap of more than 6 percentage points annually, compounding. The trading was not neutral. It was actively destroying value. And the primary identified mechanism was this: premature profit-taking and extended loss holding. The advice is correct. The brain does the opposite, and knowing the advice provides almost no protection against it once the trade is open. But here's where most traders make the structural problem worse. The natural instinct when facing losses is to improve the win rate. When losses accumulate and the win rate drops, the response is immediate and logical. Tighten entries, wait for more confirmation, take only the highest probability setups. The thinking is simple: win more often, and the account recovers. The win rate goes up. The expected value gets worse. Here is the mechanism. An entry taken after 3 confirmations is more likely to work than one taken on a single signal. But by the time those 3 confirmations appear, price has already moved. The entry price is worse. The stop loss sits at the same structural level. The profit target is unchanged. The reward to risk ratio has narrowed. The trader boosted their win rate from 55% to 65%. Their average winning trade dropped from 1.5 R to 0.8 R because they are entering late. Expectancy is worse than before, even though the win rate looks better than ever. Dalbar's annual behavioral research documents this pattern. Their data consistently shows that average investors underperform their underlying funds not because of poor asset selection, but because of behavioral timing, entering after confirmation and exiting early to protect gains. The same sequence that creates the optimization trap in active trading produces the same outcome at the portfolio level. There is also a market structure dimension. Retail traders cluster entries and exits at predictable technical levels, just above round numbers, just below recent highs, at the obvious consolidation zone. These clusters are observable, and market microstructure research documents them. Price frequently extends through these exact levels before reversing, right where the confirmation entries are placed, and right where the early profit targets sit. The late entry that boosted the win rate is opened exactly where the move typically ends. 3 forces are now aligned: an incomplete formula, a neurological mechanism, and a behavioral pattern applied to fix the first two that makes the underlying math worse. There is one calculation that cuts through all three, and almost no retail trader has run it. Most traders track win rate. Almost none have calculated the expected value of their system. Without that number, there is no way to distinguish a system with a genuine edge from a slow, organized bleed. The calculation is not complicated. Take your last 20 completed trades. Find your average winning trade in R, find your average losing trade in R. Multiply the average win by your win rate. Multiply the average loss by your loss rate. Subtract the second from the first. If that number is positive, you have an edge. Over a large enough sample, the math wins regardless of individual trade outcomes. If that number is negative, no amount of discipline, no refined entry criteria, no better chart reading will fix it. You are applying effort to a system that cannot mathematically work. Consider what positive expectancy looks like when win rate is below 50%. A system with a 40% win rate and an average winning trade of 2.5 R has an expected value of 0.4 R per trade. This trader loses 6 out of every 10 trades. Their win rate looks poor. Their account is growing. A system with a 65% win rate and an average winning trade of 0.5 R has a negative expected value. This trader wins nearly 2 out of every 3 trades. Their win rate looks excellent. Their account is declining. Dalbar's research reinforces this at scale. The documented underperformance of average investors is not explained by the assets they held. The assets performed adequately. The underperformance was generated by when they entered and when they exited, which is the expectancy problem expressed at the portfolio level. Without this number, every trading adjustment is a response to emotion. The only signal that matters is the expected value across a meaningful sample, and most traders have never looked at it. So what does the trader who survives this do differently? 3 things. Not mindset adjustments. 3 mechanical actions. Calculate your expected value before you change anything else. Take your last 20 trades. Find the average win in R and the average loss in R, and run the formula. If the number is negative, no entry refinement, no psychology work, no better indicator will fix it. The system does not have an edge. You fix the math first. Remove decision-making while the trade is open from your process entirely. Pre-commit every exit before the trade opens. Stop loss, profit target, scale levels, all of it decided and recorded before you enter. Once the trade is open, those levels do not move. Not because of discipline, because the research is clear that every decision made while you are in a profitable position is distorted by the neurological pressure to close it. Make the decisions outside the trade. Stop measuring your trading by today's win rate. A single session tells you almost nothing about whether your system has an edge. Expected value plays out across a large sample. The trader who understands this is not shaken by 3 consecutive losses. They know the math is running. They know the edge expresses itself over time, not over a morning. You are not a bad trader. You were given half an equation and told it was complete. Win rate is the score. Expected value is the game. Stop counting wins. Start calculating expectancy. Tell me in the comments, have you ever calculated the expected value of your system? Most traders haven't. I'll see you in the next video.